many members of our team who at different points were down with Omicron or some other illness, or had close family members who were affected. So there was many disruptions, and many people had to work from home in very difficult circumstances. So let me say that a very big thank you to all of you. Many of them are sitting right here in front of me, so if you can raise your hands and wave. Please, a big round of applause for them, because they put in a really big effort. Finally, let me welcome my dear friend, Dr. Anantha Nageswaran, to the Ministry of Finance as the new Chief Economic Advisor. So a big round of applause for him as well. So, as many of you may have noticed, the economic survey has gone through another change in its format. We will be going for a different format, but it is important in this context to go through a very quick history of this document. So the economic survey as a document has its origins in the early 1950s, when it started out as part of the budget papers. So it is not published separately, but as a part of the budget papers. And the earliest one that I could find is from 1957. It was a very short document, only 38 pages long. And it was basically a descriptive document. It had some recent trends, but not much by way of analysis, and almost nothing by way of recommendations and so on. So it was a very simple document, but nevertheless, that's where it started out. You can see on the left image, one of the earliest ones that we have images for. This is the one from 5960. Now, through the course of the 60s, the document became a lot more substantial. A lot more data, charts, tables, etc. began to be added to it. You also began to have a Hindi translation at that stage in the 60s. And by about the early 70s, this became a more substantial document, about 150 odd pages. So you have on the right an image from 1973. Now, through the 70s and 80s, this document took a life of its own. It was by this time being presented as a separate document a day before the budget. So by now it has a character of its own. A lot more tables and charts are added. A statistical appendix is added in the end. And it begins to take on the form that is now much more familiar to what you would think of as an economic survey. I've got the one from 85-86. Many people in this room will perhaps be familiar with that cover and may have studied it when in university. Now, the economic survey of 91-92, as you can imagine, was particularly awaited because that was during the crisis of 91, and you had the reforms and so on. And this is the first time that it appeared in 2 volumes. The first volume was a very thin volume, only about, if I remember, some 30 odd pages, but it was the first time that 2 volumes were published. The second volume was much more traditional sectoral analysis, and but in the following years it reverted to being back a single volume. But the document kept growing, and of course, with the advent of computers, the graphics and so on improved very dramatically. So by, as you can see, 2001, 2002, the covers become much more colorful and so on. Then, during the global economic crisis, the document, a few extra thematic chapters were added to it by the then Chief Economic Advisor, Dr. Arvind Vemani, perhaps to explain the predicaments of that time. So you began to see a shift, somewhat of a shift from the purely sectoral approach to adding more themes. And it became a longer document, certainly by 2011-12, that you have on the screen. It was by this point almost 500 pages long. Now, it then became split into 2 volumes in 2014, but that was a split in 2014 into a text volume, which was mostly done in a sectoral format, and a statistical appendix volume. So there was 2 volumes, but in this format. But in the subsequent years, it ended up with a volume 1 and a volume 2. The first volume tended to have thematic chapters, and the second had the more traditional chapters from the sectoral type chapters. That has now been changed in this economic survey, and this is what it looks like. there is a volume 1, or you can call it the text volume, the economic survey itself. That is the main volume which we just released. But there is a second volume which is the statistical appendix, and it's been given a character of its own. It's been refreshed. Many old tables have been removed, new tables have been added. For example, new kinds of data like GST, IGST and so on have been added. There's a whole new section on high frequency indicators as well, in line with some of the thinking that I will now talk about. Now to the content of the economic survey of this year. Now, one of the clear points we make right up front in the survey is that there's been a revival of economic activity to pre-pandemic levels in the year 21-22. This shows through in the national accounts, and it shows through in a whole bunch of high-frequency data that we have. I've just, for illustration, put the e-way bill collection, and you can see that there was a big contraction during the national lockdown last year, then a sharp revival, a more shallow slowdown during the second wave. So even though there was the health cost of the second wave was much more severe, the economic cost of it, by almost all accounts, was much milder. But there was an impact, and then a subsequent revival. So where does that leave us? Well, as you know from the advanced estimates, the economy this year is estimated to have grown by 9.2% after a contraction of 7.3% in the previous year. And you can see on the slide on the right that it is now a little bit above where it was in terms of economic activity, where it was before the pandemic. So in other words, we have now grown past the pre-pandemic level. What does it mean in terms by sector? This sectorally, we tend to look at it as a GVA, or gross value added perspective. And you can see what happened to different sectors, and the very last column is a comparison with the pre-pandemic era, which is 2019-20. And you will see that the agriculture sector, not surprisingly, this is the sector that was the least affected by lockdowns of various kinds. So this is a sector that grew even in 2021 and then again in 21-22. So in that sense, it is now a little short of 8% above where it was in pre-pandemic phase. The industrial sector did go through a contraction, but then it went through a significant revival as well. And now it is about 4.1% above pre-pandemic levels. And the subsectors went through a slightly different trends, but as you can imagine, the utility sector didn't go through the same kind of contraction, because obviously water supply, electricity, etc. don't get shut down during a lockdown. But manufacturing, construction, and other such sectors did go through a contraction and then a revival. In fact, if you look at the quarterly data, they will go through this downturn, sharp downturn, revival, shallow downturn, and flatter, then a more sustained revival. I scratched my head thinking about what would be a good letter of the alphabet to describe this. And after a lot of discussions with the best minds, we thought that the best we could do was maybe a tilted W. I know it's very awkward, but so I didn't bother to use it. Now moving on to the services sector. Now the services sector is definitely the sector that was most affected by the lockdowns. And you can see that it is just a little short of where it was pre-pandemic. But I think the real story is not in the headline number, but in the subsectors. And you can see finance, real estate, professional services, or public administration, both of these have actually gone back to pre-pandemic levels. But as you can imagine, the contact-intensive subsectors of services have been much more severely affected. And you can see that it is this segment, which includes, of course, tourism, travel, hotels, those kinds of sectors, that is still continues to be below pre-pandemic levels at about 91.5. So it's about 8.5% below where it was pre-pandemic. So this is clearly a sector that is still impacted. Overall GVA at basic price is about 1.9% above where it was pre-pandemic. Now we can do the same exercise from the demand side, looking at real GDP growth, and you can again see that when you look at total consumption, it is just shy of where we were before the pandemic. Government consumption, of course, has been reasonably strong, not surprising, given a lot of spending that's happened, particularly on the health front, but on other kinds of things, including providing safety nets to vulnerable sections of society and of the business sector. So private consumption, on the other hand, still lags. Now, if you combine this private consumption number, which is at 97.1% of the pre-pandemic level, and the discussion in the previous slide, you can see where the hit really is, because this is all those contact-intensive services where obviously spending is constrained because you are under lockdowns of various kinds. In fact, we are just gone through one thanks to Omicron just in the last few weeks. Meanwhile, the gross fixed capital formation has recovered past the 1920 level. The key point here, of course, is that a lot of this is driven by government spending on capex, particularly on infrastructure, which we will also return to a little later in the fiscal segment that we will discuss. Exports have been a major driver of growth, and you can see they are now very significantly above the pre-COVID level. But of course, imports have also been very strong. Overall, GDP is 1.3% above where it was pre-pandemic. This is in line with what we saw calculating from the GVA perspectives. Now, of course, it's all very good for an economy to have recovered like this, but we continue to remain in uncertain times. There are geopolitical risks bubbling up in various parts of the world. Oil prices have spiked up just in the last few days, in fact. There's going to be very likely a withdrawal of global liquidity by major central banks, and that is something we have accounted for. So taking all these uncertainties into account, it is important to see whether our macroeconomic indicators can provide us a bit of a buffer through this recovery process. The first one we looked at was the fiscal performance. And you can see that the data that we have available for April to November 2021, which is the data that is publicly available with all of you, and it's not surprising from what you have probably been following anyway, that there has been a very sharp increase in both tax and non-tax revenue collections of the government. And it is not just the case that these collections are high on a year-on-year basis from the pandemic hit numbers of 2021, they are actually very significantly above what they were pre-pandemic as well. So this is real, genuine, boost to revenue collections of the government, which is great because this allows support for another leg of the government strategy, which is support for capital expenditure. And you can see that capital expenditure is now a level above where it used to be pre-pandemic. I mean, this was something that was ramped up very sharply through the second half of the last financial year as part of the demand push, but has, as you can see, been quite strong ever since. And so this is a very important part of the government strategy to both support demand on one side, but also create supply-side assets for the future. Now, where does that leave various deficits? Well, as you can see, the numbers available for April to November, obviously the estimates for the full year you will get tomorrow morning, but the publicly available numbers for April to November clearly show that the fiscal deficit is not only below what it was for last year for the same period, but also below what it was in the pre-pandemic phase in nominal rupee terms. This is also true, by the way, of the primary deficit, which is very substantial. It's half of what it was in the pre-pandemic period in rupee crore terms. So this is a very substantial correction. And of course, if you think of it in terms of percentage budget estimate, you can see that traditionally, because a lot of the revenue in India tends to be front-loaded, the fiscal deficit of the first half or the first in this case, April to November period, tends to be above the overall full year, and then in the course of the next few months it comes down. But you can see that April to November 2021 has been particularly good, with numbers coming in at just 46% of the full year number. So this is a particularly good performance. Now moving on to the financial sector. Obviously this is always an area of macroeconomic risk and stability that we need to look at. There were many commentators who had expressed the fear during the last 2 years that the financial system would become very stressed as a result of this shock, this pandemic-related shock. And you can see, however, that this sector actually has weathered it rather well. Whether it's the gross NPA level or the net NPA level, both of them have continued to steadily decline through the last couple of years. And this is even true after the initial IBC moratorium was removed. So this has not gone through a spike after that. And the banks continue to increase their capital adequacy ratios. So they are becoming much more better capitalized. This is important, that even if there's some later lagged impact of the pandemic on the economy, the banks are well capitalized, and they seem to have taken the pandemic shock in their stride. Now, of course, the financial sector is not just about stability, it's also about growth. And the last couple of years did see credit slow down significantly. But in the very latest numbers, you can see that it has begun to tick up again. But the good news is, because you have a banking system that is well capitalized, when the demand for credit arises, this banking system is in a position to provide that credit where appropriate. Also important to note how strong the capital markets have been. And you can see the amount of resource mobilization that has happened through IPOs through this year. In fact, just the April to December number is good enough to reach all-time records. So we have already crossed all-time records in the first 3/4 of the year. So not even taking the last 3 months, we are already in record territory. Now, of course, when people hear about this, they tend to have in their minds that what we are really talking about is all the big corporates or the unicorns that everybody likes talking about these days in the media. But the fact is, what you are witnessing here is a change in risk appetite and animal spirits in the economy, which is very much widespread across the country and at every level, and particularly showing through in this field of startups. So here I have two maps. The one on the left is just from 5 years ago. It shows new startups in India as of the year 2016-17. These are not just any company that happen to have been established. These are companies registered with DPIIT as startups using certain criteria. So they are proper startups. And you can see in the year 16-17, there were these few sort of concentrations near Bangalore, Hyderabad area. There was one concentration near Mumbai, and then one in the Delhi NCR area. But most of the country really didn't have a startup culture. Now, 5 years later, that has completely changed. And this is, by the way, data as on 22nd of December. We have not even finished the year. And you can see a complete change. There are at least 555 districts in the country with at least one startup. This is quite incredible. And you can see it's scattered across the country. There's obviously the usual suspects, Delhi NCR area. There is Mumbai, Pune area. There's another hub near Ahmedabad. And I mentioned Bangalore.